To jump off here with David Williams, investor and forecaster from Page Trader, joining us to further this discussion and take a look at some key levels that, David, you've got your eye on. Happy Tuesday. Welcome to the show. Thanks again for joining us here. Let's begin with, now that we've breached that $80 level, what should we be watching?
Yeah, good morning, Ben. Great to be here. Thank you for having me. So the market has shown some pretty powerful movement to the downside. Yesterday, just as an example, oil fell for a second consecutive session to their lowest level in over a month. So we are seeing some take back here as traders look past President Biden's decision to drop out of the race. And I think they may be, from a fundamental viewpoint, they may be focusing on the rising stockpiles that we have and signs of somewhat weaker demand. It is interesting that the crude traders have sort of taken Biden's decision to drop out of the race kind of in stride. It hasn't really seemed to make that much difference. Maybe some of the difference leading up to this was in anticipation of it. I'm not sure. I'm not really good at fundamentals. But I just want to say, looking at the fundamentals, it appears that they've shrugged that off. And we still have the growing tensions, as you just mentioned with your last guest, in the Middle East. For many months, our forecast has been that as long as crude stays above $70, and we believe that it will, on monthly closes, it would then advance to $90 to $91 in the second half of this year. We're in the second half of this year now, and I just want to reiterate that our technical work isn't paying attention to more minor moves. It's more of a larger scale technical analysis that ultimately those smaller moves would be in favor of. Right now, they're going counter to it because the market's going down.
Okay, well, I was going to say there's really no need to be focused on the fundamentals when you are as good as you guys are in terms of nailing the technicals as you have, and I should say over the last couple of years. Take a look at this chart real quick. I just want to point to how we are now below the 50, now below the 200-day moving average, but you can also see how it's been kind of flatlining, right? So sort of speaking to that limited volatility containment, right, which we've been arguing for a while. David has been very supportive of the move up, the rally we've seen in stocks. I think investors like to see crude oil prices kind of in a range.
Mm-hmm. I think that's a great observation. Investors certainly, especially stock investors, futures investors, they want to see crude oil active and volatile. It's kind of a center for volatility in the market. You with your last guest, and I really enjoyed your last guest. I just want to say, we're speaking about markets like copper and so on. And those kinds of markets for many, many years can be very, very quiet. They can get down to low levels and stay there for a long period of time. Crude has a built-in amount of volatility that, like natural gas, which is almost the Arnold Schwarzenegger of volatility when it comes to markets. And I love both those markets because of their volatility. So I think it's very true. Investors do like to see a volatile crude oil market.
Man, I feel like it's been a while since we talked natural gas, but very true that, and words of wisdom in terms of those two majors. Let's talk a little bit more about, again, some of this recent weakness here. I feel like, you've got multiple factors, but ultimately, if we start to see some weakening economic conditions, if we see jobs, some of the concerns associated with, again, those factors that feed into or support prices, do we still see this balance playing out? Or do we see, probing lower levels ultimately to retest some of those lower extremes, David?
Well, first of all, in what you could call the cycle of years, we're in an election year. This is not a year that we would normally expect to see the weakening conditions and stuff. This is the ultimate year for window dressing. This is the ultimate year for things being good. And even though, as your last guest said, the world is just a hot mess, and it is, but the election year cycle is very positive, generally speaking. We don't do a lot of our work just based on seasonals or including this year being the election cycle, but we do pay attention to the fact that we're in it. And yes, I believe that if something very unusual were to happen and we were to get, say, monthly closes below $70, that shifts everything into a whole nother context where crude oil would be down in the probably the low 50s if something like that happened. So what we've learned over many years, and I'm sure you've seen this as well, Ben, is that the more critical the price level is, the more dangerous a particular level is, the better a trade it produces. The safer a level is, and traders are always looking for a safe level to go long or go short, but generally speaking, the safer it is, the trades aren't so good from that. The really good trades come from levels that are really quite dangerous to trade at.
Absolutely.
And if they reverse there, you know what I'm saying? And you get really good moves out of those levels.
Some of the best longs look like the worst trades at the time, right? They kind of go in the face of reason in many ways. Ultimately, hey, just taking a look and standing back one more step from some of the price activity we were just identifying the range-bound contained aspect of. I just went all the way back to, we're going back to 03 here right now. Yeah, you got a spike high up around 147, 148. You got the lows around the pandemic we saw where we actually went negative, you know, if you remember. But here we are sideways at 80. This is contained range-bound and very much in the middle thereof. David, appreciate you joining us and sharing part of your Tuesday with us here on the Schwab Network. Always good to have you on the show. David Williams, investor forecaster at Page Trader.